go as quickly as we can through this. I don't want to rush, but at the same time, I understand, that we only have a few minutes each class session. Okay, so we are looking at the topic of cash, of projected or financial statements. And, it's a category of analysis that is called prospective analysis. It's the same basic thing as what your chapter describes, where you are looking to the future, right? So you got your financial statements, which are basically once upon a time information. They are, in other words, that already happened. But now we are wanting to use the past and information from the present to give us some idea as to what the future will, should, could look like. And that's the purpose of what you are doing now with this particular chapter. I do want to emphasize this though, and I'll say it again later on in one of the other slides. No matter which of these prospective statements you are preparing, the starting point is still going to be the same. You always start with sales. And so if it's a business that you're running, you would get your marketing department together, you get your salespeople together, and you say basically, how much do we think we can generate in revenue for the next year? And that's your starting point, okay? So bear that in mind as you are going through your cash flow projections or your financial statement projections. So just to give you a sense of what we're doing here, when you're focusing on short-term lending, you're really looking at liquidity. Remember, we looked at liquidity ratios. So that's your primary focus when you are doing short-term lending, a line of credit for a year or a note for 90 days. But when you're doing long-term financing, it technically is no longer just about liquidity now. It's about solvency, the company's ability to meet their long-term obligations. So are they able to generate cash flow on an annual basis that will enable them to repay the debt? So just a little bit of technical analysis there for you to be thinking about. So with prospective analysis, what we are doing is we're trying to get a sense of what the future holds for a particular business, right? We know how they have done. We know how they did even for the interim period that we may have financials for, but what are they going to be doing going forward? Because let's face it, we're not going to get paid with the past. We're going to get paid with the present and the future. And so we want to know what that future looks like. Clearly, we don't have good crystal balls, but we can certainly get an idea. And there are two major tools that are used here, at least discussed in your textbook. One is the cash budget, and the other one is the pro forma or projected income statement, projected balance sheet, projected statement of cash flows. And what I did was I actually went through the tedious process of preparing one of those. And having said that, I will also tell you that if someone, a lender, not a lender, but a prospective borrower gave me the financials that I'm sharing with you, I would have so many questions about those, beginning with, the amount that they project for sales. So when you're preparing a cash budget, what you're doing is you're looking at expected cash, right? Because you don't know what this future is going to hold. But these are the three major areas that you're focusing on. And so we're looking at expected cash inflows, expected cash outflows, and expected cash balance. And of course, the only thing that's missing from this slide is that we begin with the actual cash that we have on hand. All right, so I'm going to show you a couple examples of a cash budget. Now, this one, you can see total expected cash inflows. As I said, there is my total expected cash outflows. And the key word there is expected, right? Which means it hasn't happened yet. And then there's going to be either a shortfall, or we're going to be right on target, or we're going to have excess cash. But what I wanted you to notice from this example is just how this is just one possible way that a cash budget could be prepared. So look at the top, first of all. You see the sales forecast, right? And this is done by month. Appreciate that the further out you go, the less accurate your projections are going to be. And so, yes, I will work with a 1-year cash budget, but don't give me a 5-year or 10-year budget and expect me to attach any significant reliance on those numbers. But this one is for January through June. And again, what we have on the first line are the sales for each of those months. So they determine that they're going to sell this amount in January. It drops off a little bit in February, and then you can see that it continued to decline in March, and so on and so forth. Then it picks up a little bit in May, and then we have back to June. That seems to be another good month. And then what they do here in this example to estimate how much cash they're going to get, they say, look, we estimate that 20% of our sales will be on a cash basis. So you can see they took 20%, and that's the number here. And then they said, well, we're going to have credit sales, but how will the cash actually come in? And so they estimate that 50% of the sales will be collected in the following month. So you see this number here, it's based on January sales, okay? So I'm not going to go through all of these assumptions because they are just that, assumptions, and each client, each business is going to have its own. The bottom line is somebody has to determine when cash is going to be coming in, how much is going to be coming in, and we add all of those inflows to get our total expected cash inflow. And then we do the same thing for our cash outflow. How much are we going to be spending? What are we going to be spending it on? And when are we going to be spending those monies? And so you can see here that they have expected cash outflows, which is a little bit less than the expected cash inflow. So that month of January looks like it's going to be a good month, right? They're going to be bringing in more cash expected than they're going to be spending. And then down here, they are saying they want to have a cash balance that is no less than $100. So clearly, they're going to be able to achieve that in the month of January. And then the ending balance for 1 month is going to become the beginning balance for the following month. So again, you can go through this, but it's the basic idea is how much cash are we expecting to come in? How much cash are we expecting to be spending? And are we going to have the minimum cash balance left over? If we don't have enough, then we're going to need to borrow. So let me show you on this one. Again, this one doesn't have the assumptions. It just shows you the numbers, right? So this wouldn't be very helpful or as helpful. But again, they have their beginning cash. You see their expected cash inflows, their expected cash outflows. And so there's a net between their inflows and their outflows of $12,615, right? So they are saying for this month, they're going to be spending more than they're bringing in. And that's the amount. And then they have their closing cash balance, which would be, of course, taking this amount and subtracting it from the beginning cash. So at the end of January, they would have this balance, but they do not want their cash balance to fall below $70,000. So they're saying that for the month of January, they would have a deficit of 7,615. So what do? Well, it depends, right? Because if they are anticipating good cash inflows in subsequent months, they may be able to ride this out and not borrow, or they could borrow this amount, at least this amount, and then you can see they have positive cash inflows in the subsequent months, so they could easily repay whatever amount or the amount that they borrowed here in January. So one of the things you can do with your cash budget is you can see where the peak needs are going to be for your client, as in large negatives. You can see where the peak inflows are going to be, and you can determine, okay, you need to borrow X amount, and we see that you will definitely be able to pay it back. And of course, by the time we get to this month here, June, they are in the red again. So maybe they need to borrow more than just this 7,000. They're probably looking at close to $12,000, $15,000. Okay, and they don't have to use all of it, but at least they'll be able to meet their goal of not falling below $70,000 each month. Again, this is just an example. The key thing for you that would be to question how they arrived at these values or these amounts. How did they determine what amount they're going to need to pay each month? Do you anticipate that to be a reasonable schedule given their history? So this is a tool that you will use to generate questions and determine if the company is being too conservative or if they are being too aggressive with their projections. All right, now this other projection is the one that maybe will be most helpful to you as far as your assignment is concerned, because I ask you to project the income statement for dry supply for 1 year. And again, there are so many different approaches that you can take. The one that I'm sharing with you is one of the more popular ways, okay? So we're looking at historical trends. Remember from previous chapters, you learned about trend analysis. You're looking at expected levels of macroeconomic activity. So how is the economy going to impact their performance? And that's one of the things that's missing from this example that I'm sharing with you. I did not take into consideration any macroeconomic data. I just focused on the trend and used that to project. All right, you can choose to do that, or you can say, look, your trend is this, but you just got a new contract, so we think you're going to do better next year. Or we think that given your average growth, that the performance for the most recent year is not representative of what you normally do. All right, so let me just quickly go through here because I don't want to run out of time. So again, this is hypothetical data, but you can see 2003, 2004, 2005. Clearly, this company is selling more each year, right? Question would be, is this because of inflation, or are they actually selling more widgets? Don't know, but that will be a question that we could ask. They're also showing more profit, but does it mean that they are more profitable? We can answer that question by doing a common sized income statement. But what I did here was I calculated the growth in sales. How did I get these numbers? Well, let's just focus on one, which is this one here, 11.455. What I did was I took the previous year's sales, 2004, and subtracted it from the sales for 2006. So that's the change in sales. And then I divided that number by the previous year's sales, right? So new minus old divided by the old is how I came up with this number. So this is saying that between 2004 and 2005, their sales grew by 11.45%. Whereas between 2003 and 2004, their sales grew by 12.336, right? So it grew in both years, but it was at a lower rate of growth in 2005 compared to 2004. So I am choosing to use this number to project next year as opposed to using this 12.33. Somebody may decide, you know what, I'm going to take the average of these two and use it because I have information that would justify doing that. But whatever you decide to do, be sure to share your assumptions with the reader, in this case, with me. I did the same thing for the other key components, like their gross profit margin, same calculation, right? The new minus the old divided by the old. And so what we're going to do now is project sales. Remember, I told you that regardless of whether you're doing a cash budget or a pro forma income statement, you are starting with projected sales. So again, you can go through the steps that I have here and see what I did. But here, for example, to get this projected sales for 2006, I took 2005's sale and multiplied it by the growth in 2005, right? So I could take 11.455% of this and then add it to this number. Or as those of you who are good at math will tell us, just multiply by 1.11455. So that will give me this number, okay? And then I do the same thing for my gross profit. I take the, actually I would take the gross profit here. To get the gross profit, I would take the sales and use the gross profit margin. So the same process is going to be used. Once I know what the gross profit is and I know what my sales are, I know my cost of goods sold, right? Because sales minus cost of goods sold equals gross profit. So if I have my sales and I have the gross profit, I know what the cost of goods sold would be. All right. So again, you can go through this step by step, but I just wanted to show you the result. And these numbers here correspond with the calculations. If you wanted to figure out where I got the number, just come and look for the corresponding number here, and you will see how I derived that number. So here is number 1, here is number 2, and of course, subtract this from this, it gives you this number here, which would be your cost of goods sold. You fill in your expenses, and there we have our net income for the next year. Any question before I move on? And again, the key thing here is to be sure that you share your assumptions. Do not just put numbers on paper, right? You need to tell the reader how you arrived at those percentages. You could just make up numbers, but that to me would not be professional. And so at least use a trend analysis. So you say, okay, dry supply, their sales grew by 5% last year. So I'm going to assume that it's going to grow by less, and here's why. Or it's going to grow by the same amount, and here's why. Or it's going to grow by a larger amount, and here's why. And you do your calculations. So that's the projected income statement. You would follow a similar process for the balance sheet. Again, I have the steps listed here. I'm not going to take the time to go through all 10 of these. But what I will tell you is if you are using the approach that I have illustrated here and also illustrated in your textbook, what happens is you fill in your assets and your liabilities and equity, and the balance sheet will not balance. That sounds odd, but the balance sheet will not balance. The plug, this is one time when you're allowed to plug, the plug is going to be the cash balance. Okay, so it's either you are going to have more cash than you did before when you plug the number in, or you're going to have less cash. So let's say you did your calculations and you had to plug in, well, maybe I'll just show you what happened here. So these are the balance sheets from 2003, 2004, and 2005. All right. And then I used ratios, like you remember the chapter on ratios. So I calculated these ratios because I'm going to use these ratios to help me to project the following year. So again, I go through and I show you how I came up with the numbers. So for example, to get my receivables for the next year, projected receivables, what I do is I take the sales from the income statement and I divide it by the receivables turnover. And you're saying, what? Well, remember when you were doing ratios in the what was it, chapter 9, you had to calculate the turnover in terms of days. Well, we're just using the same formula, but now the unknown is the receivables, right? We used the sales and the receivables before to get this number. Now we have these two numbers, so we're using them to get to the receivables. So this is a little bit of algebra, if you will. But basically, to get the receivables, you take your total sales and you divide it by the receivables turnover. If you have forgotten how to calculate receivables turnover, just go back to the chapter on ratios and you will see it there. All right. So I have my receivables. I do the same thing for my inventory. I do similar type of calculations for my assets and so on. And then I come up with this balance sheet. However, do not be surprised if you were to attempt this. The balance sheet will not balance. The plug is going to be cash. Now, if the cash balance is too large, then what you would do is you would decrease the cash and decrease a liability, like accounts payable, not accounts payable, notes payable, for example. Okay. If it's not enough and you need to borrow more, then you would increase the cash and increase your notes payable. But for beginners, the plug number is going to be to your cash account. Okay. So this is what the balance sheet looks like based on all those calculations. And again, these numbers here, you can go back to the previous slide and you will see how I came up with the number. You're not being asked to prepare a pro forma balance sheet, but if you were, this would be a good guide that you could use in order to achieve that goal. Okay. And of course, after all the time that we've spent 2 chapters on the statement of cash flow, the standard and the UCA. So I just could not show you projections without showing you a projected statement of cash flow. How did I get this? I'm pointing to you, but you wouldn't be able to see that. So let me come back here. How did I get this statement of cash flow? I use the balance sheet from 2005, the projected balance sheet for 2006, and the income statement that I projected right back here for 2006. So you'll notice that this 2,185, which is the net income, is what I used as my starting point for the statement of cash flow. All right. And of course, just like any other statement of cash flow, you add back your non-cash items, then you take care of your current assets and current liabilities to get your operating activities. Then you go into your fixed assets, capital expenditures. Then you go into your financing and you get long-term debt, we're paying it down. Dividends, we're paying dividends. And this is our net change in cash. And this is what the cash balance is going to be at the end of the period. How will we know that our projections were valid? Not until the actual financial statements come out for